Hello to everybody. Hello to all traders, and welcome to this monthly engagement for our US non-farm payrolls. Once again, today is Friday, the 1st of November. I hope everybody is having a good month. I mean, on the trading side, we're expecting the NFP today, so a lot of volatility to come in the markets. A new month starts as well, so we should be nice and fresh to start again the week on Monday anyway. So today we're going to get some good signals as to I would say, medium and long-term direction of the dollar following the FOMC decision on Wednesday. If this NFP, of course, is not as good as many expect, that would validate or even actually opposing Fed's sort of wait-and-see mode, because as said, they did say on Wednesday that they will now stop cutting rates and reassess, review the markets. Anyhow, this is my social media. If you would like to follow me on LinkedIn and Twitter, I have daily videos there analyzing the markets, of course, and other posts with trading ideas and Elliott wave analysis. Before we go ahead, I have to read to you the risk disclaimer. Foreign exchange trading and investment in derivatives can be highly speculative and may result in losses as well as profits. Foreign exchange and derivatives trading is not suitable for many members of the public, and only risk capital should be applied. This webinar is provided to you for information purposes only, and no information contained herein constitutes a solicitation for the purpose of the purchase or sale of any commodity, security, or investment, nor should it serve as the basis for an investment decision. Orbex Limited does not guarantee the accuracy or completeness of any information or analysis supplied. As usual, the agenda is always the same. We're going to have a preview of the NFP, what analysts are expecting. We're going to see whether those expectations are actually optimistic or not. Economic indicators that help with projections and why. Okay, we're talking about leading and also lagging. We'll give you some suggestions following, of course, some short analysis. Then we are going to see how we can choose the best pair to trade, depending on different components, of course, of a pair's strength, how we can protect our capital, and then we're going to go into the charts. All we need to do on the chart is just draw some support and resistance levels, and on your own discretion, you can go ahead and use those as to initiate or to terminate some sort of trade. So, analyst expectations. We are expecting another increase from 136K to 172K. The September's NFP, which was the release released in October, okay, the NFP, or the analysts, I say, they missed expectations by 38,000 jobs. This is quite a number, I would say. I mean, anywhere above 30 and up to 50, let's just call it moderate. But anything above 50 is a massive number. The 38 is quite big. So there is, of course, cyclical slowdown in the manufacturing sector in the US. Business conditions are the ones that are a bit still holding strong, but not over the latest, the most recent data, if I'm not mistaken. And that is, of course, causing a slowing in the employment change. However, the economists still expect a similar expansion to what they expected last month, okay? And that raises, of course, some questions as to whether this estimation is maybe a little optimistic or not. But we'll find out very soon, actually, right? Now, the October's release was worse than September's, so we've got 136K versus 168K. But note that September's NFP was revised up from 130K to 168, okay? So this is something that it's providing some sort of good signal on the side of the data and the projections. However, note that even with this upward revision, the forecast There you go over here at 172 was still missed, although only for 4,000. Now, continuing on to the preview, I want to always shift the attention to other pieces of data, right? Because the NFP is not just the headline number. Okay, we have unemployment rate, which is falling, and we also have the average hourly earnings, a very critical component, especially around this time, where we have the Fed cutting rates for the third now consecutive time, and inflation falling, which adds a lot of downside risks. And of course, the rises the excuse me, rises the possibilities of a recession. Now, the unemployment rate has remained unchanged. The expectation. So we're expecting again a 3.5%. In September, the analysts beat expectations of 3.6, and of course, unemployment strengthened to the 3.5 rates that we currently see. Now, hourly earnings are critical for this report, okay? As the interest rates are now much lower. This is a typo. Previous figures softened by 30 basis points from 0.4, okay, to 0. That's the actual figure. And that is actually not seen since December 2016. So we're talking about a nearly 3-year low, okay? In a couple of months, it would be the case. Now, wages, they're not upbeat, okay, any longer, because they finally crossed below the 3%, okay, at 2.9. And that leads to inflation struggling to pick up on a low interest rate environment. But the year-on-year is expected to increase this time, okay, at 3.4, which is a 50 basis points increase, which I haven't seen for a while, if I recall correct. So that might be too optimistic. That gives us the markets the opportunity, I would say, to sell in case we don't get that. And why? Because obviously, if this is too optimistic and we're going to get a number of 3.3 or 3.2, it is not going to be positive, right? So if I was at 3.2, the estimation, and we got the same number, then we'll probably look in and focus more on the employment number, on the headline, and also unemployment rate. Now, in terms of CPI, okay, the latest data in October release showed that year-on-year the CPI inflation fell from 1.8 to 1.6. It did match expectations, which I don't really find particularly important around this in this environment, but still falling while rates are falling, and while it moves further away, of course, from the trend line. Now, we talked about some indicators that we wanted to look at, and this is some sort of modeling that anybody can do, anybody can follow, and also there is a table in the following slide, to get a better idea, just to get a hint of how the economy has been performing over the past month and up to the day of the NFP, of course, because looking at that piece of data gives us some insightful information regarding the state of the manufacturing, for example, the employment from ADP, the consumer confidence, and other important economic data. Of course, all of those data are affecting employment in the US, and that is why it is a fundamental let's say, economic way of working out what our expectations could potentially be. So, with that being said, there is lagging indicators and leading indicators. The lagging indicators, of course, are the ones that are delivering some sort of piece of data after a certain time. The leading ones are the ones that they are live on the markets. So lagging ones are the ISM manufacturing and non-manufacturing PMIs. We need these because they show us information about business conditions in manufacturing and services, okay? So if there is a decrease or an increase on those, that also indicates that there might be also a decrease in employment activity. The challenger jobs cards and the jobless claims, these two show us information on layoffs and how many people claim for unemployment benefits. So these ones are a little bit less lagging because the jobless claims are coming out on a weekly basis. So we can get a better idea as to how these fluctuations are going to affect the employment activity on a monthly basis. Then, of course, we've got the ADP Non-Farm Employment Report, which is just monthly employment data in the private sector, okay, and it's released by ADP. And this one, of course, is a good, many people think is a very, very good economic indicator to look at, but I want you to understand that it should have, according to the statistical data that have been, they are checked, it should have like 10% only accuracy, okay? And that's because we are sampling 60,000 eligible households versus 640,000 work sites, okay, on the NFP itself. So don't really consider the NFP as something that is you know, a very accurate sort of piece of data, okay? Now, the other one is consumer confidence. We're talking about University of Michigan and also the CBCCI. The surveys are used to measure behavioral mood and also consumer optimism, okay? So they affect the spending and also savings. And those are the two that give us very good signals on where exactly we are on the business cycle. And leading indicators, treasury yields and equities, and also the crude oil prices. Now, when yields are up on the same day, or they have been going up, right, but mainly on the same day as the NFP, market sentiment is bullish. And that means that market participants are projecting a good NFP for the particular day, okay, or month. Equities are assumed to be positively correlated in this case, okay? And now on crude oil prices, when oil prices are up, market expectations are somewhat positive, as the boost in inflation raises the prospects for higher wages, okay? Now, this table I talked to you about, okay, what we simply are doing here, we're taking the most important economic data, okay, the latest one as well over the past month. And we make a pros and cons table comparing with the forecast and mainly and also looking at the previous piece of data. Now, as you can see, we've got the ISM non-manufacturing, including the employment component figures, the ISM manufacturing, including the employment component figures, challenger job cuts, the ones we just saw in the previous slide, right? Jobless claims, ADP non-farm employment, the consumer sentiment, CB consumer confidence, and also durable goods orders. As you can see for yourself, most of those are showing that the economy hasn't been really performing good, which could be indicating that this NFP might not be as good as some expect. Now we have, on the lagging indicators, at least we have 1, 2, 3, 4, 5, 6, 7, 8 versus 2. So we're talking about an 80-20, right? So 80% of the economic data are bad, 20% of the economic data are kind of good, but I would still keep an eye on the ADP because it's actually, it stood the same figure as last time, right? As the expectations at 105K. Now, the leading indicators, however, they are mixed, okay? Treasury yields are a tiny bit up, which doesn't really indicate much of a direction. Equities are down, quite a bit, I would say, and crude oil is up. Crude oil is up most compared to the other two leading indicators. So, in my opinion, economic data have been going bad, okay, which means that unemployment rate might go a little bit higher. And then we're looking at the treasury yields. at an inflation as well going up, and also the yield is like not moving much, to be honest. The crude oil rise could be indicating that the wages are going to be quite good, maybe somewhat balanced compared to expectations. So this is how we can start creating our own sort of modeling and understanding of what we are to expect for this specific NFP. Now, this is of course used mainly for those who want to speculate ahead or at the time of the release. There is other opportunities, obviously, following the release itself, and this is always the best scenario, considering the high volatility and the high risk, the high slippage that you can experience during the NFP. Now, on this table, and also accompanied by a graph, we can see the global interest rates, okay? The most important banks around the globe, around the world, and which ones have moved. Now, since the past NFP, the only bank that moved was the Fed, okay? We went from 2% interest rates to 1.75. Eurozone remained on hold. Japan remained on hold. UK remained on hold. We've had, of course, Australia and New Zealand cutting over the past 2 or 3 months, if not mistaken. QE, New Zealand cut 50 quite aggressive basis points, if not mistaken. But anyway, the point is that the interest rates in the United States are falling, okay, and this is affecting yields. Now we're looking at this table because when we are choosing what pair to trade, we really want to look at which currency offers the best yield compared to another, and obviously those that pair would be the higher interest rate versus the lower interest rate. In our scenario, we have the United States dollar against the Swiss franc, okay? That could be traded only if the NFP comes out good, okay? If the NFP comes out good, it means that the least strong pair or the most weak, let's say, against the, and this is from operational flows, right? Against the United States dollar, USD will be the franc. So if you have a good NFP, we can assume that the USD CHF can be traded. In the opposite scenario, where the United States, the USD is going to be pushed down because of a bad NFP, then we're looking at the stronger yield against the US dollar, and that will be the Canadian dollar, okay? So in case the NFP is bad, we can trade the USD CAD pair, and that means that that would move to the downside, okay? Now, there is, of course, another method to choose what pair to trade. Actually, no, 2 methods. But the other one is pretty obvious, I would just say, which is the usual suspects. This is the euro dollar and the dollar yen, okay? Everybody's trading, so it doesn't really matter what's happening much if you are going to trade for the short term. But in the longer and medium term, it does actually matter. You cannot use this method. Now, back to the method we are seeing on this slide. This is a currency strength meter, okay? And we are pretty much monitoring what pairs or what currencies are performing well against others. As you can see, the strongest currencies as we speak, I think this screenshot was like an hour ago or so, if not mistaken, maybe even 30 minutes. We've had the Norwegian krona, which we don't want to trade, too volatile, and the spreads are obviously, and the slippage big, and of course the pound, okay? Now, the pound is strong and it's a liquid asset as well, so we could trade that against the dollar if the dollar was to weaken. And The Canadian dollar, as you can see for yourself, it doesn't really look that there is much going on. It's quite weak, and it's weaker than the USD, right? So we really need to look at those two different methods, one in the longer term and one in the short term, okay? The longer term is that we follow the monetary policy / yield perspective, and this one is we're looking at the current strength of the of particular currencies against one another, okay? And that will be the short term. So if you are in the short term, then GBP USD, if USD goes lower or the NFP doesn't come out as good as expected, and USD against JPY or against the CHF or against the Canadian dollar, any of the three, I would personally go for the yen at this environment, and that is because the Bank of Japan appeared to be a little bit more dovish than expected, and is actually more dovish than the SMB is, as well as the Bank of Canada. So if we consider those as banks, Bank of Japan is most dovish. So in case the NFP is out strong, then USD JPY for sales. Now, of course, I need to notify you on the risks, okay, about the NFP. You can just avoid trading completely. Explain why in the previous, in the last few minutes, okay? This high volatility, high risk, high slippage. If you are going to trade, use a stop loss and a take profit, okay? That way you can avoid risk management, not avoid risk management, you can avoid the emotional hurdles pretty much of trading in such volatile markets, okay? Number 3, you can close all your positions, okay? And just, you know, so that you can divert risk away. You can hedge your positions if you have any open, okay? If you're eager to trade, you can let the markets come down first and then go in after 30 minutes or 1 hour. And the most important, of course, is to analyze the post-data, the data post-release, okay? So we have normally seen whip shows, and it's important to know the post-effectual biases and how the employment, wage, and also unemployment data are affecting those. Now, another thing that many may not have known or maybe not heard before, the divergence between the actual figures and the estimation is important. If it's small, we're not going to see the markets moving much, okay? If it's big, we are going to. But whatever the case is, we really need to keep a sharp eye on all the components of the NFP, not just the headline, okay? Now, what I will do is I will just open my charts here, my trading view. And I want to go on, let's just go on the euro dollar first. I want to go down on the 1 hour chart, and we can start drawing some support and resistance levels that do make sense, okay? So in most cases, this is an easy job, okay? We have this level. Actually, let me draw this line because it also shows automatically the levels as well. So we've got 116.65, yeah. That might not be, we've got that. 111.34, okay. We've got another level over here and another level over here. Now those levels, you can use them as you wish, but I'm just drawing high activity levels and nothing more, okay? So these high activity levels are a good indication of where prices could, where a lot of entries and exits can be enabled. Let's look at dollar yen. Dollar yen is a bit harder to draw any support because it's been bearish over the past few sessions, 2 sessions if not mistaken. The other one can be down here, of course, on the on the upside, we can look at that one down there, and on the downside, since we are below that level, we can look at probably that one over here is a good dynamic level. And if in case we go lower, we'll want to go over there. Okay. Pound. Guys, just so you know, don't look at Elliott waves. Don't look at where markets are going from a technical perspective, on cycles perspective, or whatever is your method, because when news are out, none of these matters. Okay, so nice and simple levels which can be used to enter or exit the markets. Okay, this one is a good one too, because we are right here. So we've got GBP USD. Let's look at the S&P and also dollar CAD. Okay. S&P over here. Obviously, the all-time high. Are we going to see a new one? It's a very interesting session this time, right? With equities reaching all-time highs. On the upside, well, feel free to go up to 1370 or so, 3070. And let's go also on WTI. Okay, not sure why these levels are here. Probably a different drawing. Let me just delete this quickly. We can redraw something more recent, more accepted, let's say, over there. And over here, these are good levels as well. We are pretty much okay. Might want to do that one as activity level. And what else do we have? We said about dollar cards. Let's also do a few support resistances on dollar card as well. This is the top. This is the bottom. Okay, this is the other top. This is an entry to the downside, entry to the upside. That distance might be a little bit, okay, it's 20 pips, it's not too bad. And then, of course, down here. Okay, and now let's just look at the, how many can we put over here? We can put 6. Okay, let's go ahead and do that then. Okay, looks like it's taking a bit of a time. Did I went too far? Let's just do 4. Oh no, oh, okay. So what I want to do now is, of course, change those a little. So let's go with Euro USD here, dollar yen here. I thought we've already drawn some lines for dollar yen. Anyway, we'll do it in a minute. Pound. Yeah. Over here we go with dollar Swiss. We didn't do dollar Swiss. It's okay. We can do dollar CAD. It seems that none of my lines have been drawn here. Well, we are moving already, so this one, WTI. So euro dollar is already moving, taking out. Well, entry and exit is already done pretty much. So that was a good quick 47, like 10 pips, let's say. GBP USD is still far. USD JPY, we had that one over here that decided to disappear. And then that one over here. WTI. USD CAD. What else did we see? I think we might be better off if we just go back to the single chart. It seems to me that the NFP is good. Let's check. Not really. Not really, but is a little bit surprising to see that move, right? So we've got unemployment rate at 3.6, as we suggested, because we said that there was a lot of negative economic data and are likely to affect employment rate, as well as the employment headline. 128, okay, 44K than the forecast, which is pretty nearly massive to the 50K mark. And now, the thing is that average hourly earnings, they were too optimistic, as we said before, although they managed to jump back to the 3%, which is considered to be a little bit upbeat. So we are back on that, back on the game pretty much. So now why we have this move is obviously to take out those break-even stops, okay, and then most likely we're going to see prices moving higher. So whatever you're looking right now, don't believe it, okay? I mean, this is quite a bad report for such a reaction. It might just be just an opportunity to take profits from all of this sort of decline on dollar yen, let's just suppose, pound, dollar as well. I mean, we have taken the break-even stops down here and moving up. Gold, high activity over here. On the downside, high activity as well over here, which is already taken out. Dollar Swiss. I'm not sure why the TradingView keeps deleting these lines. Maybe, I don't know, maybe just because I did everything too fast and it kept loading without any lag pretty much. So we're heading for, that's a good activity level. Dollar Swiss franc. But don't forget, we're also looking at that to come lower anyway. Yeah. And then, of course, on the downside, over here, or even a little bit higher. Dollar CAD, okay, taken out, unlikely to go up there. Oil is moving up. Well, inflation, average earnings, as we called it. Equities, SPX, the S&P is moving up after a good retest down here. Most likely going to be taken out, maybe a little bit higher. We might see a new high, but highly unlikely, only if really this will continue this way. But in my opinion, this is highly doubtful. The dollar is moving up. Anyone knows why? refresh. So unemployment rate worse than expected. Headline number worse than expected and quite a big divergence. Average hourly earnings worse than expected, better than last time. And on a year-on-year basis, worse than expected, but also better than last time. So wages did quite well on the market basis, but not on an economic basis. And now, as I said in the beginning of this webinar, a bad report could really affect the dollar in the medium and short term up to the end of this year for the quarter. Because following FOMC's statement or Powell's statement that the Fed now will actually halt the easing further and wait, which was, I mean, not that he was bearish or hawkish, but he stopped being as bearish, dovish, sorry, as the markets expected. And when that's not dovish, it's causing a move to the upside. Okay, now, considering now that what market participants saw as an over-optimism, considering that now this over-optimism is being really also proven and validated by the data itself, I mean, dollar should really be moving lower. Participation rate was the only thing that made a difference, 63.3, better than previous and better than the expectations, but only 10 basis points. Okay, so the other fact to look at is that we are expecting ISM manufacturing PMI in 1 hour. Okay, so we might not see all flows coming in right now at the NFP. There might be some sort of reversal flows or continuation flows later in about 1 hour. So I'm really curious to see, though, how this develops, because it's really surprising to see the dollar moving higher. Now, here's one thing to do. If you haven't traded, you really want to trade, and but not during the release. So this is when the second sort of method, what we said, for those that they are a little bit more risk averse, you can wait for the markets to settle and then decide what trade you want to take. Okay. Now, what we can do, since we're moving down here, okay, we are going to go to the high momentum insertion level, which is over here. It's not up there, it's over here, 111.55, okay? This is the opening or closing of the previous one. We'll go there and then we'll draw a Fibonacci retracement down to the lowest level. Now, let me just fix this quickly. 618. Let's add those levels there. Okay, we've got pretty much all of them. And the trend line should be that color so we can see it. I think the colors are better like this. Now, let me just add the retracement levels as well. Now, normally, right, we would see prices go to the 5th Fibonacci retracement or 61 max, and then continue with the move to the downside. The thing is that technicals don't really make sense because they don't match the economics here. They don't match the report. So I'm expecting prices to move up, which means that in that scenario, what we can do, and here's what we can note that down as a trick or something. What you can do is we can add an extension level above that one, you see, 1.382, and also the 1618. And what happens in this case is we can see what is the potential of prices, what are the targets, the projected targets pretty much, okay? So we've got an opportunity to go up to 111.66 on euro dollar, for example, and 111.72, which is pretty close to the activity levels that were drawn before, correct? And on the downside, we can do, what we can do is just do a minus 0.618, for example, and we'll get the same level metering on the downside. So in case we move down, probably gonna head down to that level. And that level is a very good activity level as well, okay, if you see that. At the same time, though, this confluence, as I would like to call, adds more to the, increases the chances, let's just say, okay, of hitting that level. By the way, this is also first time probably that I ever see this. 1.11111. So we've got 5 ones. I've never seen that level using Fibonacci retracements for years. Quite random, no? So on the dollar yen, let's go back and have a look what's happening. We can do pretty much the same. So as we said, we came out, we took this break-even stops out, okay, both levels. Now we want to go and draw from there up to the top, which is here, okay. So 0.50618 prices could drop over here, and then move up or turn around and go all the way down to 1.785 or 1.778, which again are very, very close to the levels that we drew before, okay. Pound, let's just do the same. Pound, on pound, there doesn't seem to be much activity, to be honest. Okay, it's like 30 pips. Pound is moving 30 pips. It's a bit of, you know. So, I mean, it's just a bit useless actually to do that on pound. Let's check gold. Gold has done this move down to the activity level over here, a little bit down. Probably even taking out, no, didn't take out the 1500s obviously, but this is a false push down to the 1500s as a round number, okay? Because you will see many people having a lot of longs over here, a lot of buy on 15, and that might be the case. So similarly to what we did for euro dollar and dollar yen, we are very close to the 0.5, but as I said before, I mean, chances that we're going to see a full reversal are very big, if you ask me. Dollar, Swiss franc, high insertion to top. Again, we're seeing this sort of mini reversion on the hourly candle. Dollar CAD, also not much. But as we looked at the currency strength meter before, right, you see that the dollar is higher against the Canadian dollar compared to any other pair, right? Look at this, for example. Look at euro dollar, you see. Pound dollar as well. However, the pound was a bit strong before the NFP, right? So S&P doesn't really move much because the The report is a bit mixed for the business world, to be honest. Unemployment up, wages up, and employment lower. I mean, it's pretty bad from all the components, but the average earnings seem to have done quite well, despite the expectations. Now, we're not talking about expectations, okay? We're talking about the actual results, where they stand on a, let's say, structural perspective rather than this just 1 month result. And let's look at WTI. WTI is moving higher, right? It's quite strong. Broken that level, we've got this. So could be seeing prices to move up. Could see price going up to 55 or so. Then the other thing, of course, that let me just get this. Where is it? Over here. The other thing we can do is, of course, look at those opportunities from a different perspective, with some diagonals coming in the play now. On dollar CAD, I'm not seeing anything that could help apart this long-term trend line over here. So we'll see in both cases there is little room to the upside. Well, here there is a lot of room to the upside, but to be honest, this is a very good rejection level, okay? This low as well. Just do that quickly, you see. Okay, I don't see anything else here. Let's move to the next one. Gold. Oh, it starts reversing. Nothing there. Pound is under pressure. Let's go and draw a trend line. Where are we going to draw this trend line? Let me check. Oh, is this going to work or? Nah, it looks like it's too far from the current level, but we can find another one that makes a bit more sense. I mean, this is the closest one, but yeah, this sort of bounce really doesn't show much. This is our chart. Yeah, there we go. That's it. Dollar yen. And there's not much of a trend line to draw over here. And euro dollar. That would be over there. So very good. It's already bounced. 1, 2, and that's it. Let's see what Financial Times say about this report. More jobs than expected. That's weird. Are we seeing the wrong data? Rose by 128 last month from upper revised 180. Let's check our calendar again. Okay, so Where are we going wrong here? 128. Okay, so we had an upward revision from 136. Interesting. There we go. From 136 to 180. This is what's causing that. That makes the previous report up a bit last month, right? Medium focused. Okay. Unemployment rate ticked up. There we go. So all this move is because it looks like we've had an upbeat NFP last month. Okay, so, well, if you asked me, NFP last month was traded last month. Revisions are to be looked at when they are considerable, and this significant. In this case, it is significant because we're talking about 80K, but it shouldn't really move the markets against the direction of the economic data is pretty much signaling that market should follow. So I would really pay attention to what happens not for the last 8 minutes, but after that. Okay, I want to see where prices are going to close on the hourly basis, on the hourly candlestick. Okay, at 3 o'clock, as we see down on our trading view charts here. So another 7 minutes, and we will have a better idea about the market's direction. It might take longer because there's a lot of times that we're not seeing much of a move closer to the end of the hour. That's because markets are still deciding whether they should continue pushing markets, higher or lower. And that might be one of those cases because they have the ISM manufacturing as well coming later. And that would be in 1 hour from now in some minutes. And they might just wait for that one to come in as well, while at the same time they are on sells, it looks like on shorts. On the euro dollar, for example, prices might remain around 111.30 or so. And once the ISM manufacturing comes out, we might see prices going lower or moving all the way up, reversing and moving higher. I'm not saying that the market direction for the Euro USD or for the USD in general depends on the manufacturing ISM, but in this particular case, be what market participants are waiting to see to either validate or invalidate the current sort of structure, let's say. Okay, so at the same time, for those who are watching, if you have any questions, you can go ahead and ask. Okay, that's to do with anything related to the NFP or any questions related to the reason that we see the market actually moving lower, despite the fact that we've had poor data. I haven't looked at the risk assets, commodity pairs like Aussie dollar is moving lower, quite weak, I would say. Same with Kiwi. Dollar Swiss is up. That makes you wonder what's happening really with euro, Swiss franc, or like Canadian dollar, Swiss franc. You see, they seem to be a little bit, moving randomly, pretty much. That really shows us, because we're talking about the strength meter before, right? That really, you can come really here and compare what's really going on. So we're looking at USD CHF. We understand that CHF is weak. Then we go to Euro CHF, we see that Swiss franc is weak. But when we look at euro dollar, if you triangulate that, then you're really looking at the Swiss franc is weaker than the euro and than the dollar. And then you can, of course, add different pairs on this sort of particular matrix and identify which currencies are weaker against the others. Okay. I recall that NOK was quite strong before, right? Okay, and it doesn't actually hold too bad, okay, in the Norwegian krona. So New Zealand CAD, New Zealand CHF, you see that pretty much they're both weak, but the Canadian dollar is weaker, okay? Old CAD, old CHF. Here, you see that the Aussie is a little bit, on Aussie against the Swiss franc and CAD, we see that the Swiss franc is a little bit weaker. That can mean that the Aussie New Zealand is moving down. Yes, there we go. So simple triangulation, and you can really identify which pairs are moving, are weaker against others, and you can trade those on the major, from a major perspective. So we know that, for example, New Zealand USD is better, is holding better than Aussie USD, which means that if we want to buy the dollar, we better do it against the Aussie rather than the Kiwi. And that's the same, of course, with the USD CHF and USD CAD, okay. Now, the one that really doesn't move is the pound. It's only just a marginal move. USD JPY is doing well. It's moved all the way up here, but then we start slowing down. We start receiving this exhaustion. Everybody has been waiting, which is pretty much profit taking. It's nothing more than that. Everybody is selling to take profits. Nobody is selling as a sort of directional move, okay? Unless, of course, that turns out to be not the case. And we're going to see that within the next 1 hour, okay? And Euro USD remains close to 111.30, as we said. So the next candlestick could be either a very good reversal, like 50-60% or so, up to the upside and close up, or we could see prices moving down, then up, and then again come and close near the this previous low, okay? And from there is what will determine the direction will be the ISM manufacturing, at least for today, which is Friday, the end of the week and the beginning of a new month. I want to thank everybody for being here with us today. And I want to give you the, just to remain available to you in case you have any questions. This is going to be, this record is going to be live on YouTube. If you have any questions, you can go and comment. I'll get back to you as soon as I can. And I will see you again next month. Until then, trade safe.